Well, I'm Rick.
And I'm Eric.
And we are your Transparent Wealth Management hosts.
Welcome to our show.
Well, another happy Friday, my friend.
Happy Friday to you too, sir.
And happy hour can't be far away. I know it's 10 o'clock here, but it's 5 o'clock somewhere.
And it's about to be 5 o'clock here.
It's
later.
been one of those weeks.
It's been, it has been.
A crazy crunching week. Our processor / customer service extraordinaire, Ryan, is now off at a wedding. So that's always interesting, even on Fridays. Mm-hmm. We try to make that administrative day and radio day and all those kinds of things. But, you know, hey, we say TGIF. TGIF. So, you know, we love this idea, Eric, about an end-to-end process. You know, the holistic wealth management model is just known. A lot of you listening out there may not be familiar with that vernacular, but quite simply, it just means it's kind of like that end-to-end process that Steve Jobs created at Apple, where that he wanted to mitigate the dysfunction, and he actually accomplished that. You know, was complemented by Bill Gates. Now, in our world, there's 4 pillars to the financial world. There's investing, there's taxes, there's insurance, and there's estate planning. So in the world of investing, you know, this debate goes on, and I don't know why, you know, fee-based or commission-based, it should be in your best interest. It should be analyzed, and then you should know what you're buying, you know, why you're buying it, and what it's going to do for you.
Yep. Taxes, you have both tax planning and preparation. So we have partnered with a few CPAs in this area to do both the planning side and the preparation side. So you know you can go back 2 years to amend or refile a return. So if you found out you made a mistake, maybe we can go back and help you. And if we can't help you, we know going forward not to step on that same landmine.
Exactly. So I think about, you know, risk management or the world of insurance, and there's so much in that spectrum. You know, there's the new life insurance, long-term care-based stuff. There's just regular life insurance. There's Medicare planning. There's all these disability, all these types of things. Health insurance, that's certainly a big issue. So those are things that, you know what you're buying and make sure you're paying a fair price for it. So I'm reminded of that Farmer's commercial where the kid's going to jump in and it looks like a big pond, which is is the metaphor for what the coverage they think they have. And before he hits the pond, it's this little small thing. You know, that's actually what you have. And unfortunately, most people don't find that out until the claim time comes, which is the wrong time. So get that audited every couple of years, get that checked out. We have some independent insurance people that can do that.
Last pillar is estate planning and elder law. So this is, you've grown your assets, you've accumulated your wealth. Now you got to make sure your estate, your legacy is in order so your loved ones receive your money, your assets, not the hospitals, attorneys, government, court, all that. So, you know, make sure your estate is in order, and also with the elder law attorneys. If you are aging or if you have parents that are aging and maybe get some spend down or you have some money that's maybe at stake of losing, you know, hook up with an elder law attorney or get some information so you can maybe keep more of what you have.
And that's the not the last, or not the least, but the last.
Yep.
So if you have a question today, feel free to call us in the final segment of our show. We will answer that question live on the air at 866-472-5790. That's 866-472-5790. We'll answer that question live. If you're a little bit shy, send it to us, info@straighttalkcleardecisions.com. That's info@straighttalkcleardecisions.com. We'll pick that up on our feed, or whether you can tweet us and we pick it up.
Yep.
So we're
at Rick Tirement, RIKTIREMENT, and we're also on Facebook. So if you want to send us a message on Facebook or follow us, we can answer that question on there as well.
LinkedIn, all those. So like us, link up with us there. We can interact, and you know, if it's again something more personal, we certainly can answer that off the air and follow up with you. So, you know, Eric, I've been looking at some of the things that are happening in the market. Now, here was an interesting thing I came across just the other day, and I know you'll hear about all this thing with oil, and everybody talks about this because we feel that when we go to the pumps, don't we?
We do.
You know, and there's always this burning question: how come oil's at $55 a barrel or $40 a barrel or whatever it is at the given point in time, and prices really drop ever so slowly? But when we hear, hey, something's going on over there and Saudi Arabia is attacking Iran and chasing ISIS, it spikes.
10% in a day.
Now, here's some facts. We like to separate the facts from the whatever, from the fiction. And here's an interesting point, according to The Economist, that it costs oil producers in Saudi Arabia, which is OPEC's largest member, by the way, just $6 a barrel to bring oil up out of the ground. $6. So if you're at $60, that is 10 times. That's 1,000%, right?
Mm-hmm.
That they're making on a barrel of oil.
At $60 a barrel.
It's $60 a barrel. So wherever oil is, and we've heard price points at 70 seem to moderate the crazies around the globe because they can run their economies. Everybody who's commodity based, they're all different, but I just find that amazing. Mm-hmm. $6 a barrel. So what's that tell you? The fracking revolution, get that right.
Yep.
It's America's future. It's how we are bigger. We are a bigger energy producer than Saudi Arabia. In the biggest, well, we have 100+ year supply in natural gas, and we're an 80-year high on oil. So you still got to wonder, where did oil 55, 56, closing in on 60?
It's closing in on 60 as of this morning.
You got to wonder. So this next one that I saw, I thought this was interesting. Everybody's trying to guess where. We know, everybody, I think, knows that the Fed's going to raise rates. We have to. But you can't do it when we're getting so many mixed signals, like the first quarter numbers. What did they come in on the GDP the other day?
Was it 0.7, I think?
No. They expected 1%. And what did they get? 0.2.
0.2, that's what it was.
Yeah, 1/5. 80% less than what they thought. Ouch.
We're supposed to be one of the few countries that are growing.
Let's lead the world down. But there's a lot of contributing factors, all kidding aside. One of the things that could quell any sense of recovery, and we are in a slow, moderate growth kind of cycle, is, we look at when the Fed funds rate. That's what the Fed lends money to the banking system at. Now, the historical norm is what? 4.5%?
Yep, 4.5%.
And we are now at 0.25 below that, right? So it's at an all-time low. That's good for servicing debt. In case you're wondering, if you think rates are getting any lower, I think not. Mm-hmm. But here's something that we used to track. You've heard we've maybe made comments that, the market has certainly not priced in a June rate increase. Well, here's an interesting factoid, that the Fed funds futures market was priced in December 2014 to reflect a greater than 50% chance of a rate hike by the Fed no later than June.
Of this year.
Now, recently, the Fed funds futures market was priced on April 20th, about a week ago, and it reflected a 2% chance that the Fed was going to raise rate in June. So the consensus seems to be September leaning into October and maybe bleeding into December. I've even heard it mentioned in the last week that it may be next year in 2016. Now, why is this important? Because neither the bond market or the stock market has priced this in.
Yep.
And the market is not running on fundamentals, it's running on stimulus. So I think that's important to know. It's important to track. So that's some of the things we're using, when we're drilling down on things to find out, give an opinion on something. How about this? Everybody's talking about the U.S. debt ceiling. That's kind of an interesting one.
It was, kind of like playing games with us right now. The U.S. debt ceiling, it was suspended for 13 months by Congress. This was, February of 2014 until March of this year, of 2015. And the total of our nation's outstanding debt as of March 15th was $18.15 trillion. That became our new debt ceiling. That was a trillion with a T, $18.152 trillion.
Is that all?
That's it. That is it. However, in the 6 weeks since March, the last 6 weeks since March 15th, the Treasury Department has initiated accounting maneuvers to delay an actual default by the U.S. government. So, we're hearing Greece defaulting on their debt. We're not mentioning the U.S. right now because we just keep raising our debt.
Yeah, well, we're the biggest horse in the herd, We're, and just a couple other factoids, over $3 trillion was taken in taxes this year, which was a record high. Now, under the current administration, whether you like them or hate them, here's another factoid. Over 422 new taxes, yep. I think, implemented by the Obama administration, not counting the 20 taxes under the Affordable Care Act. So, I mean, that's a massive tax increase. Now, a little factoid on that, when we look at taxes, you hear about this, what do I want to call it?
Be careful.
Yeah, be careful what you say. It's class warfare, right? Well, here's some facts. The bottom 60% of taxpayers, that's 6 out of 10, are estimated to pay less than 3% of the federal income taxes for 2014. So they're less than 3% of the $3 trillion, which means that 40% pay 97% of the taxes.
Of the tax bill.
So you gauge for yourself whether you think that's fair or there's parity or whatever. The bottom line is that, those are the numbers. Mm-hmm. So that's a nice little thing to break out at the cocktail party.
If you want to get a
nice neutral conversation.
Yeah.
So, I look at this thing, and as far as with the debt ceiling, and we're realists. So there's both sides of this equation. People think, and I heard a great example by Dr. Ben Carson, one of the best illustrations I've ever heard on this. If you want to get a concept of $1 trillion, start counting one number per second. Now, assuming when you get to 1,000, you can continue that, and you can't. It would take you something like 457,000 years
to get to 1
to count to 1 trillion. Now we have 18 of those. So it's obviously a big challenge. Now, on the optimistic side, energy is our key to the future. That is the new middle class. And interestingly enough, I just heard something last week that, it's being touted where our unemployment numbers dropped to 5.5. However, what's not in the narrative is that 2 states account for the lion's share of that number, which are North Dakota and Texas. And what are their mainstays for jobs?
Energy
and fracking. So the very thing they're opposing is the very thing that's dropping that number, but you don't hear them say that. Now, we got to get this right. And if you want a good read on a book, if you're a reader, pick up this book. I don't get any royalties or anything off this, but it's by Russell Gold, and it's called The Boom. And I think the second subtitle was How America, grew out of its the next cycle or whatever, for expansion. Because it's too important not to get this right. As we said before, and that book has got the good, bad, and ugly of fracking. Mm-hmm. He doesn't pull any punches. He doesn't slant one way, and he basically says we got to get this right. If we don't do this, this $18 trillion could kill us.
Yep.
And that's just, those are the facts. So just like Joe Friday on Friday.
Joe Friday on Friday.
Okay, so some interesting things here. As far as creditors, let's see, what is the outstanding government debt as of 2/28/15 was $18.2 trillion. And that was comprised of $13.1 trillion held by investors, known as debt held by the public, which are bonds. The $5.1 trillion held by the U.S. government entities like Social Security, Trust Fund, etc., is 47% of the 13 points. So it's almost half of the 13.1 trillion held by non-U.S. citizens. Japanese, 47% of the 13 is held by non-U.S. citizens. So that's less than half. I think we actually hold more. Again, we still hold more of our own debt than anybody else. So when you hear these things about, hey, look out for China, well, here's some factoids. The Japanese investors hold 9.4% of the 13.1 trillion, 1.2, and just fractionally more than the treasury debt held by Chinese investors. So China's still behind Japan, who is friendly to us. You hear about what happens when China calls the debt. What happens when we call our own debt? we got 53% of it. Mm-hmm. So we're still the lion's share of this. Again, the facts are really what we want to look at. So just interesting things. Thought we would open it with a few factoids here that maybe give you a little better perspective on the market, what's happening economically. Here's one more in parting. 5 years later, as of Friday, April 24th, only 4 banks, 1, 2, 3, 4 banks have failed year to date and required a bailout from the FDIC. At the same date, in 2010, 57 banks had failed year to date. That's a huge difference. That's a sign that the economy is improving. We're
stabilizing.
We're coming out of that, what I want to say, the crisis point. But, I still got to say there's some things that concern us as far as, say, the price of stocks, PE ratios. And we mentioned this last week on our show. Price to earnings ratios, the price of the stock to the earnings they spin off. But what about, tell the listeners about what a cyclically adjusted price to earnings ratio is and where it's at.
If you go back, just showing you where it's at right now to give you a little better perspective, we're at, I think it's a tad under 28. It's like 27.2. If you go back in history, the only other two times the CAPE, the cyclically adjusted PE ratio, CAPE, was higher than it is currently was in 1929 and 2007.
Just before a crash of 83%?
83% and 51% in 2008.
Ouch.
So
now, we're not saying the market's going to crash. What we're saying is you got to pay attention to the warning signs.
You have to look at, just because you like a stock doesn't mean you have to buy it every single day. You want to buy it at good points. Where's a good entry point? When you're looking at everything is overvalued, it's just like when you go to buy a car. You're going to pay more than what the car is worth? No. You might like the car, wait for it to come on sale maybe.
Now, one of the things that we might mention in this is that, the commentary you hear us running on using demographics in our practice. This is the work of H.S. Den, and obviously nobody has a crystal ball. You can't forecast what's going to happen. And the opinions we're going to express today are going to be ours. Clearly ours, not our broker-dealer. We are registered investment advisors as well as under a broker-dealer, NPC. These are our opinions. And anything today is educational, should not constitute investment advice, tax or legal advice, and you should always consult with qualified financial, legal, or tax people or real estate prior to taking any action. Just makes sense. So today, Eric, we're going to talk about a very good topic, a timely topic, one that keeps coming around and keeps coming up. It won't stay down. And the question is your financial advisor clueless about retirement planning? And we actually have some tough questions that should be asked. So you need to get a pencil and paper handy, but at the end of the show, if you ask us, just request it. It's Straight Talk, info@StraightTalkClearDecisions, or call us at 866-472-5790, and we'll send you this list of questions. But we're going to delve into these, and we've got, about 25 or so?
There's quite a few. We'll see how many we get through today. It seems like this hour comes and goes pretty quickly.
I'm game. I like a challenge. Be sure and go on to our website as well. www.straighttalkcleardecisions.com. You can request our e-newsletter, absolutely free subscription. I write a view every week there, or sometimes we're going to be traveling here, so we're going to have some guest views. But much like our show, it's information you can use. We've got a view on the market, or overview overall on a topic. We have a recipe, we have a philosophical quote, we have the headlines, and I love that views. Mm-hmm. That comes out the demographics group that says this is what happened and this is what it means to you.
Simplifies it and breaks it down so you understand it. We have a golf tip of the week. We've got our speaking schedule, not just the radio, but all the speaking events that we do. We also, as Rick mentioned at the beginning of the show, we pride ourselves on having that holistic view. So it's not just money papers and investment decisions. We've got estate planning white papers. We have insurance white papers. We have tax planning white papers and research reports. So get on the website, StraightTalkClearDecisions.com. Check it out. Ask for anything and everything on there, and if we have any left, we'll be more than happy to provide it.
So, when we look at this topic, is your financial advisor clueless about retirement planning? Well, here's a couple things to consider. Ask yourself, what kind of conversations are you having with your financial advisor? Are they just focused on returns, or are they on how they compare to the market? Because it's much more than that. Are they talking to you, or are you talking to your advisor about strategies on how you withdraw money from your IRA or 401k in order to avoid what could be tens of thousands of dollars in taxes and penalties? Have you had the tough conversation about how to protect a surviving spouse from significant changes to their taxes and Social Security benefits?
Has your advisor explained exactly how and when to optimize those Social Security benefits, including if you're eligible for any additional benefits that aren't listed on that Social Security statement you receive? And have you addressed how to protect yourself from the skyrocketing cost of healthcare, or if you should even consider long-term care insurance?
And I'm going to tell you what, Eric, this is just the tip of the iceberg. But these are the tough questions that we're going to give you today and the conversations you should be having with your advisor. And unfortunately, most people are only getting a small sliver of the entire story. So the question is, are you getting the whole picture or are you just getting a piece of it? Well, in this next segment, the next two segments, or 1.5, we're going to explore the critical components of a comprehensive retirement game plan so that you're sure that you're getting the whole picture.
That's right.
So stay tuned. You're listening to the Straight Talk Clear Decisions radio show with your Transparent Wealth Management host, Rick Saylor.
And Eric Hamburg.
Money is an awesome thing if you know how to handle it, the joy it brings.
Hey, Rick Saylor here. Have you considered the options for maximizing Social Security? 3 things I can tell you about it. It cannot legally go broke. It's an all-or-something system, and smart planning involves strategically integrating this with the rest of your income choices. Don't make the $100,000 mistake by not planning appropriately. Consider retirement income, survivor, and spousal benefits because there's 81 options for couples and only 9 for singles. Options and strategies like file and suspend or claim now and claim more later. The difference between age 62 and age 70 is 57% more income for life. So be sure and ask your advisor today about Social Security planning.
Rick Saylor, smooth financial sailing for the best part of your life.
Well, you're listening to the Straight Talk Clear Decisions radio show with your no-nonsense, holistic wealth management host, Rick Saylor.
And Eric Hamburg.
So on this topic, Eric, is your financial advisor clueless about retirement planning? How do you know this? How do you find these things out? Well, I
think first you got to be able to ask the right questions. That's
know
where
the
it starts.
questions
You
to
have to
ask.
know the questions to ask. It's just about anything. You don't necessarily feel like you've got an answer unless you can ask those intelligent questions, and that's what we're here to do, to tell you what those questions are, to ask them, and to make sure they can explain to you what those answers are, what their process is, or why they do certain things. But if you don't know what questions to ask, where do you know where to begin?
So we might as well get into them because we got a bunch to cover here.
We do.
So, the first one is, do you know exactly how and when I should be taking my Social Security benefits? And I'll follow up with this other one. Are there other benefits I'm eligible for that are not on my statement? Now, why is that important? Well, in income planning, and we've said this before, we've got another show if you want to go listen to that archive. First of all, Social Security is not the butt end of jokes. There's 3 things I can tell you about it, is that it's cannot legally go broke. It's an all or nothing system. It's smart
All or
planning.
something system.
Yes, all or something. Thank you. Not the all or nothing that we hear about. So, and the last one is, coordinating this with smart withdrawal strategies can help your money and your savings investment last as long as you do. So we have seen numbers that say that an income source like this, treat it like a pension, because, getting a smart strategy, for example, if you wait, but the difference between age 62 and 70 is age 70, by the way, age 62 and age 70 is 57% difference for life.
It's an increase.
More. Not counting the cost of living adjustments, which have been 2.8% since 1951 or so. So when we look at that, we've heard also from other sources that can be as high as somewhere between 1 to 3% more return comparatively in a portfolio over your entire lifetime, and that's massive.
It is.
So this is important. So if your advisor's not even talking to you about this, and why would they not talk about it? Because they don't get paid to do it.
Yep. And one of the things too that's not on your statement, people think, well, it's just my benefit. Well, there's really 3 types of benefits. Usually a widow's benefit.
Oh, you got retirement, spousal, and survivor.
So it's not just you; it's about you and your family, or you and your spouse, and maximizing it. So ask about Social Security because I don't think before it used to be. It could be the income it can generate.
What did they say? There's 3,172 different
combinations.
Combinations. 3,172. That's all?
That's it.
That's all you got?
For right now.
So, I mean, those are important things. And again, because of when you're looking at how you're going to make money, you say, well, what am I going to live on if I don't take Social Security at 62? Well, consider this. If you have which we'll get into a little later, if you have an advisor that gets paid by assets under management or a fee-based manager, which we do, we do everything, why would they want you to draw off their money that they're advising because their paycheck potentially could go down? Now, I look at it the other way, and when we do financial plans, comprehensive financial plans, have we ever seen a financial plan not show more success when they delay Social Security? And that's initially, that's just retirement income. I'm not talking about, we see it on spousal. You know, sometimes you say, hey, well, you can, and there's all kinds of options here. We're not going to get into that today. But, well, you know, I'm going to touch on it. So file and suspend or a restricted application.
We're feeling good on Friday.
Generous, yeah. So, I mean, these are important things. So if they're not having these conversations, because you can't call up Social Security and get these answers.
And
they're not advisors.
And it's not on the application. You have to write it in for the most part.
So you got to get this right. It's huge. It's huge in terms of not outliving your income, which is the number one fear, according to a Gallup poll a year ago, among baby boomers. So that was the number one.
And kind of what goes hand in hand with that is, when can I claim Medicare and what will it cover?
Where's Jeff Hendricks when you need him?
That's the two questions. As soon as we hear that question, it's all right. Here's Jeff Hendricks' card, and we'll hook you guys up and let him go. But it's How
about some simple things like, do you have to file at 65?
Well, certain parts you do, and if you don't file, I think it's Part B.
It's a 10% penalty every year. Now, the exception is if you're still working.
And you're covered.
Or if you're covered under somebody who's still working, you can delay. But the window for that, once you quit, is something like 6 months. From that point, the clock starts ticking. And you can get a 10% premium penalty that you can never get away from.
For the rest of your life.
For the rest of your life.
And then.
So when those go up, that's compounded in, what I want to say, reverse inflation.
Yeah.
You know? Because you get a cost of living adjustment in Social Security. Well, when those premiums go up, that's going to compound that.
You know, one of the misunderstandings of Medicare is every year in the window season, which I believe is end of October through beginning of December. I don't know the actual dates. That's your window season when you can go and change.
I think it's October 15th to December 7th.
Yeah, it's something. Right, that seems about right.
And I don't know, they move slightly, but
it's the open window season. But what that does, that allows you to change your Medicare plan. So if you're going to be jumping on certain prescriptions for the next year, or you're going to have this physical therapy, you might want to maybe get a plan that's going to cover more of that type of benefit than something that you're going to pay more out of pocket.
And I'm going to say you may want to look at the Alphabet Soup plan, with the show that we did with Jeff Hendricks. I think it was back in November. It was during the open season. Mm-hmm. Yep, and that should be archived on both our website, straighttalkcleardecisions.com, and also the Voice America. But critical choices to be made there that are, impactful for the rest of your life. And heaven forbid, I mean, do you need a supplement? I mean, those are all the things, and I think Jeff has a giveaway for that. That was a great
closing piece on that is, assuming you're covered for everything in Medicare, a husband or husband, a wife, a spouse, if they have all the coverage, they're going to pay up to $9,000 just for Medicare each year in retirement. It's $4,500 a person. So have you planned for a $9,000 annual premium, basically, and hoping that's going to cover every sort of health care you need for the rest of your life?
Like Scooby said, if you didn't, rut-row. So I look at this, what will it cover? Well, I can tell you one thing it's not going to cover is long-term care. And again, we have hoping to get a guest on the show to talk about Alzheimer's, because it's just a huge and exploding, disease. I know personally that this touched me personally with several members of my family. My maternal grandmother, now one of my maternal aunts, and my mother had, dementia. Maybe not full-blown Alzheimer's, but, it has that same kind of effect. So, do you need long-term care insurance? Well, a couple shows ago we talked about can't remember who did that survey, but a $318,000 out-of-pocket estimated expense for a couple, long-term care. So, the question is, are you going to pay it yourself? Because if you don't get insurance, that's okay. You just have to make sure you've got the money managed properly so that you can pay for it yourself. Because I got news for you. You look at that demographic train coming into the station.
Not.
There are 92 million baby boomers born between 1932 and 64. Lay that down like a train. The engine of that train is 83 this year, and the caboose is 51. 10,000 baby boomers a day turning 65. If you don't think that's going to impact the cost, you're just not awake. And this could be one of those deals. This could be a deal breaker. Mm-hmm. And I saw my mother trying to take care of my dad. And there are a lot of resources. There's a lot of, maybe long-term care insurance isn't the answer. Maybe you're a vet and you got coverage under that. But knowing what the veterans' benefits are. And my mom got those as a spouse. My dad was a 2-time Korean War vet. So we're dealing with that generation in the front wave of baby boomers that, saw active duty, and it's just good to know. So reach out to us, ask us.
One of the questions I know I always hear is, well, I know somebody, they pay $3,000 or $4,000 a month for that care. Well, that the amount's going to differentiate. We have clients today that pay about $2,000 a month, and we have some clients in the upper end that pay almost $12,000 a month for this care. So it's not, how much am I paying, or my brother, my sister, my neighbor's paying this amount. It's going to depend on the services, so you can't just put a fake number out there and say I'm going to pay $4,000 a month, because it's really going to depend on what your issues are.
And just one parting note, there's different forms of this. We don't get into this, but traditional long-term care is use it or lose it, and we're seeing huge premium increases on that. So there's some alternatives that have, like what I personally bought was life insurance-based long-term care, where I've got a death benefit of $1 million, and I can actually start spending down the death benefit.
Tax-free
before I die. Now, there's triggering events. It's all over the chart. I'm not going to get into this. But, that's a huge pool of money I can use. And if I just die, it pays out tax-free to my heirs.
So, somebody's going to get the benefit. You just don't know who.
Just don't know who. So if you want to find out about the new form there, then, and there's rules and guidelines. You got to qualify medically. So it's not a simple discussion, but one that needs to be had.
Next one here is, as a financial advisor or retirement advisor, how do you provide value? And I think this is probably one of the more critical questions to ask is, I can go buy a stock by myself. I can go buy a mutual fund by myself. Well, what type of value, what do you bring to the table? And that's huge, because you have to understand what's their process. Is it just investing like they want to, or is it based on your goals, your vision, your values?
And I think the next one really is, it dovetails into here. Do you provide a comprehensive retirement planning process? Do you provide comprehensive retirement planning? Because it's planning. That's why we're talking about, you talk about income planning, Social Security optimization, estate planning, this holistic approach we call it. These are the things that bring value. And maybe somebody says, hey, I got that all covered. So maybe you don't want to hire a retirement advisor. You're picking your own, investments, and you're doing okay on yourself. And you've covered everything else. So maybe you don't need to work with somebody. Save the money.
Or if you're working with somebody and they do the estate planning, they do the taxes, they do the investments, and they do the insurance. It's more about a team approach, and that's what that's what we're big on as a team. Have the expert in that field. We're on the money side. We've got the tax partners that do taxes. We have the insurance partners that do insurance. We can let the attorneys that handle the estate planning, and it's making sure they're all working together.
So how about that next one?
Let's see here. Do you have advanced financial planning education, or do you have experience? It's not. It might not be the letters behind your name. It's what type of markets have you been through? Have you?
Well, I look at for example, let's use ourselves, and I don't want to shine a light on us, but like us, there's an immense amount of resources that are made available to you, because the most educated, most informed investors are the ones we like to work with. Now, people come into us and they don't understand it. Some people say, hey, just take care of this. Well, that's fine too. But the one thing that we will continue, and you should look for, is somebody who's continually and willing to educate you. They're not afraid of telling you how this thing works. And we're not. It should be transparent, which is why our motto and one of our trademarks is transparent wealth management, for that very reason. Now, that comes up to this next one. How do you get paid? Now, I've been fond of saying, and you have as well, Eric, I want to know how everybody's paid so I know how I'm going to make money. Mm-hmm. So here's one of the questions. I'll make it real simple. Are you fee-based or commission-based? Now, there's not an either or here. The answer is yes. You need both of these, because sometimes people are better off just to pay a commission. It'll fix the solution, and it's better for you as a investor. And other times, it's better to have it actually advisory, as we call it. Like I've gotten this question a number of times. Well, can I just hire you, for advice? Well, sure. Well, understand one thing we're not going to do. Colonel Sanders wouldn't do this. Coca-Cola, Pepsi, nobody is going to tell you what their recipe is. I'm not giving you specific trades because I'm not going to be held responsible for that. I will give you sectors I like. I will tell you what the tide is rising. We can have general conversations, but it won't cross the line into actual portfolios because that is our recipe. So then that's fair, But I don't think that anybody that you ask should be ashamed of telling you how they get paid. So I think that's a key thing in determining if I know. Now, let's just look at this realistically. Everybody has self-interest. If somebody says to me, oh, I don't care how I get paid, either number one, you're not telling me the truth, or B, you're not aware, and either one of those work very well for me.
And
you should be very proud of, and I would say this, let me turn that around. It's not just what it cost you, right, in fees. It's what we pay, what you get paid. What do you get paid when the market goes up, and what do you get paid when the market goes down? Two sides to every coin, because it's the losses that have the hugest impact in retirement planning.
Yep.
If you lose 50%,
you got to make 100% just to get back to where you started.
You know what our motto is?
Don't lose 50. It's easy. So, I don't. It's not funny, but I hear it all the time. Well, I do it myself, so there is no fee. Well, there is a fee. It's not necessarily a fee. It's a cost to you. If you're riding the market up and down.
You could be the most expensive financial advisor out there.
Correct.
Because if the market, like you look at the S&P 500, which is an index you cannot directly invest into, and right now in the last 6 years, that's rewarded you pretty handsomely. What's it, about over 205%?
Yeah.
Which is the longest run in the history of the market. March 10th, 2015 marked the 6th year of the bull run. Now, the question is, will it continue to go up another 205%? Or are we long overdue for some considerable pullback and correction? Because like you mentioned with the cyclically adjusted price-earning ratios, those are a little spooky.
Yep.
There's some free information here. Be sure and ask us in the next segment, the final segment of the show. We're going to carve out some time to take live questions at 866-472-5790. That's 866-472-5790. Or if you're a little bashful, don't hear yourself on the air, that's okay too. info@straighttalkcleardecisions.com. info@straighttalkcleardecisions.com, or tweet us @RickTirement, and we'll answer it right on the air. So either way, anyway, we want to give you, the listeners out there, answers to questions that you need, and if you want it answered off the air, let us know that too. We'd be glad and happy to follow up. We have a free giveaway that we're giving. We offered this last week, and because our phenomenal response,
we're doing it again.
We're doing it again. So a financial organizer. Now, what's the value of this? In dollars. It's one of these things where I love that Visa commercial where it's priceless. The paper, the components, I don't know, it's $150, with the compiling of this. I'm going to tell you what. The value of knowledge. Knowledge is power, and the value of that is priceless. There's a what is the glossary in there?
It's a glossary. Terms? It's a leather-bound zipper portfolio. Basically, has a calculator inside there. Has a glossary, so we give you kind of like a financial dictionary. You hear somebody talking about something, you don't understand what it means, it's more than likely in there. We've got a place where you can put your statements. We've got a place where you can put your information. If you have any CDs, you have any safety deposit boxes, where they're located. It's just a nice organizer to get yourself organized if you're not, and if you are, maybe you can consolidate a lot of stuff and put it in one place. But it's an absolute free giveaway.
So how many people do you want to give this to?
I'm thinking, the first 10 callers, the first 10 emails.
First 10 contacts we get, we're going to give that to. Absolutely free, no obligation, no cost. So stay with us. We're going to stay on this topic. Is your financial advisor clueless about retirement planning? And try these tough questions to find out. We're only scratching the surface and getting through this, but we are going to get to the bottom of this. You're listening to the Straight Talk Clear Decisions radio show with your no-nonsense hosts, Rick Saylor
and Eric Hamburg.
Money is an awesome thing if you know how to handle handle it, the joy it brings.
Hey, what about estate planning? An up-to-date will guarantees you're going to go through probate, and without, well, don't worry about it, the government will decide for you. The three enemies to an estate today are number 1, the federal inheritance tax, 2, probate, and number 3, income tax. So your choices here are you can give all your money away. That might not be any fun. You may need it. Or you can create a trust to hold those assets. And remember, you don't have to own the assets to enjoy the benefits. So a revocable living trust can help avoid the expenses and costly delays of probate, and along with a living will, power of attorney, durable health care power of attorney. So be sure and ask about our attorney partners today for a free consultation.
Rick Saylor, smooth financial sailing for the best part of your life.
You're listening to the Straight Talk Clear Decisions radio show with your no-nonsense host, Rick Saylor.
And Eric Hamburg.
Eric, you know there's a lot of social media that we're on. Quickly, if you want to tell our listeners how they can track us, follow us.
Yep. So if you're on Twitter, it's at Ricktirement, RIKTIREMENT. We're on LinkedIn, and we're also on Facebook at Rick Saylor Financial. So get on there, follow us, like us, ask for any of the free giveaways, and we'll be more than happy to get it out to you. You can also visit our website, straighttalkcleardecisions.com. And if you like hearing yourself on the air, give us a call, and we'll take a live questions from anybody and anybody. 866-472-5790. That's 866-472-5790.
Well, I'm fearless, and you just scared me with that offer. Anybody and everybody. Just give us a good question. Give us a good question. I know we've done a lot of teaching and done a lot of invites. We get some good questions
If not,
all the time.
we're pretty good at redirecting non-investment questions.
There you go. There you go. So here's quick 5 things. I'm going to just give you, you're listening here and you're going, hey, I'm not really getting something much of value. You know, the 5 signs you need a financial advisor. Here's quickly what I would say. You're receiving, or the warning flags, you're receiving a tax refund every year.
You don't know how much you pay for your investments.
You don't have a strategy for down markets.
You are not sure if you are saving enough money.
And you have not set up a survivor or legacy plan.
So if you can answer yes or no or I don't know to any of those questions.
If you're positive on all 5 of those, then you're good. If not, you may want to consider some of the rest of these questions that we're going to ask. So let's take these next kind of in a group, these next 3. Who's actually managed my investments? What's your track record and what's your background? Well, you know, those are important. Are they just a gatherer of money? You know, and I'm not saying that's a bad thing, because some people are, you know, better, managers of managers.
Yep.
We do some of that. When we find that, you know, we're not picking things that we like, we may find somebody we think is representing a sector better for us. We have no qualms, and we like the cost that we see in it for the benefit that we're receiving.
Yep.
And we can see their track record.
You know, the other thing is in regards to a track record, to giving, you know, one investment or one team or one firm 1 year's worth of performance, it's not necessarily an accurate picture. If you timed it right and you got in at the bottom of the market and the stock market just went through the roof, you might think they're the best investor in the world, and maybe they got lucky, maybe they are good. You know, look at for a time frame. Typically, it's 2 to 3 years. In those 2 to 3 years, you're probably going to see some sort of correction in the market and how they reacted and how your portfolio.
Although the last 6 we haven't.
We haven't, which could be ever more
But
important.
let me interject a thought here, Eric. You know, it's not just about, hey, do I have a 5-star fund, right? You know, in the Morningstar rating system. You know, it's more like this. How much of the upside of the market, what percentage of the upside of the market is this model, and make sure it's risk adjusted, right? How much of the upside of the market am I catching, and how much of the downside am I going to catch? Because that's, you know, upside, downside of the market are quantifiable components, and portfolios can illustrate, and then a separate component altogether is dividends.
Yep.
Dividends are tracked in that. So you ask the question, what's your total rate of return? If you're a dividend, you know, focused person, which quite frankly, right now in this market, we are.
Yep. And you also, you know, if they have an answer, that means they probably have some sort of process or some sort of strategy, which is very important and critical, especially in today's market.
So how about this one? Are you a fiduciary? What does that mean?
Are you a fiduciary? You have to not just work in your client's best interest, but it's got to be suitable. And that's very, very important because, you know, one client might be long-term growth oriented. The other client might be very, very conservative, and you can kind of tell yourself, you can put one investment one way, the other investment the other way. But it's that last part is it suitable? That's what we take on very proudly is, we're not just here to sell you something because it fits you. We want to make sure it's suitable for you as well.
Well, and that's suitability, I think, is just kind of the general, because I think about Goldman Sachs, who sold what they call long and short positions to different investors. We could not solicit to somebody under a suitability. That met the suitability requirement. So in 2007, before the mortgage market collapsed, Goldman Sachs was selling upside and downside positions. And, we couldn't do that. If we said, hey, look, we think this is a bubble, it's going to crash, it's going to pop, I cannot submit that as a solicited position. If you insist that you want me to place that order, then that's what I'll do. But I'm not recommending you do that. So that's the difference. Fiduciary also encompasses a little bit more, and that is taking ownership. That's a good way to think of it. Mm-hmm. So as registered investment advisors, we have the ability to go onto multiple platforms and work with those investment build models and in some form or fashion help execute those trades along with your help, in a very timely fashion that helps you achieve that risk-reward relationship. So I think that's important because, far too many are not fiduciaries. They're not taking ownership. Look at some of these other things quickly, just planning type stuff. How and when do I withdraw money from my retirement accounts without paying unnecessary taxes, fees, and penalties? So there's a lot of strategies. You could be younger than 59 and a half. You can still avoid these. There's strategies to this.
And the other thing to remember, if you are a baby boomer, the majority of your money is more than likely in 401k or retirement plans, so almost all your withdrawals are going to be taxable. So now it's being very efficient on when and how you take those withdrawals from those accounts.
So how about a couple planning things here? What happens to the surviving spouse if one of us dies early in retirement? Well, that's a huge question. Unless you want your surviving spouse, to show up at your grave and leave a gift every day that you don't like. Of course, you won't be here. But no kidding. I mean, this is a serious topic. And, and what if, mental capacity, I was talking about my mother's situation. What if I'm incapable of making decisions, and how are they going to be handled? I mean,
and who will handle them?
There's basically 4 documents for sure everybody should have, and one of them is a financial power of attorney and a healthcare power of attorney, living will and a will. If you're a candidate for a trust, which I think far more people are than not, just avoid probate, keep things private, and maintain control. But those are all things that can be explored. And again, find a partner. If they don't have a partner here, that they should be able to connect you with somebody who's capable, competent, and competitive. Then it's just hard to kind of go through the phone book.
Yeah. And one of the other questions is, what's the most efficient way I can pass along my wealth to my kids and my grandkids?
A multitude.
It's not just about growing your assets. It's about passing them to the next generation. So when they receive that asset, or that charity receives that money, they're getting the most of it. They're not going to lose, 25% of it right off the bat to taxes if possible.
Here's a huge one, and this would be a whole show in and of itself. How can I pay for skyrocketing costs in healthcare? Those are estimated to rise substantially. We've given some numbers in the past shows, but the number 2 concern among baby boomers, and rightfully so, 63% or something said, I'm afraid I'm going to sustain a health expense or illness or something I can't pay for.
Yeah.
I mean, this could be a game changer. So a couple down here as we wind down, then we're going to open up for the questions.
Yep. What are the rules regarding taking money out of my retirement plan? So,
Many and often, right?
Yeah.
I mean, it depends. Depends on the plan they're in, right?
Because every employer has its own set of rules, and not every single one of them is the same as the other.
And that is their role as an administrator. And again, all those rules, we do 3-way calls regularly with our clients and or prospects to find out
what their rules are,
what those rules are, and make sure you don't step on a landmine, because you got to be considering all aspects. How much of my income can I replace in retirement?
That's the golden question right there.
Well, and that also answers another one, doesn't it? Am I going to outlive my money?
Yep.
So, and how much am I going to spend? We talked about that a couple of shows ago. Are you going to live lavish? Or are you going to live more lean? That's up to you. But, this replacement of income and what that lifestyle, that standard is going to look like, is dependent largely on that, and it should be something that should be done in a dynamic and integrated financial plan.
Yep.
All right. Well, as far as how does an advisor get paid, can I pay you by the hour? Now, we kind of addressed this one. Mm-hmm. You know, there's going to be a limited amount of services and information. You're not going to get portfolios, typically. No. You're going to get sectors. You know, hey, I like a trending sector. You know, healthcare, for example. 92 million baby boomers turn in, on this wave of this train. The front wave's 83 and the caboose is 51, and it's just going to keep coming. It's going to drive up the cost. So I look at a sector as healthcare and say, looks like a growing demand. Is it all going to be profitable? I don't think so. So here maybe are the sectors we like. You go find your own representations for those sectors.
Yep.
And here's a huge one. Are you always legally bound to act in my best interest? Well, here's something to write down. What is their investment policy statement? IPS, investment policy statement. We, for 7-8 years, have been under a rule that requires us that we cannot give you advice that's not in your best interest. Now, that is what, Eric, we were talking about fiduciary, kind of dovetails into that. You know, the difference between just meeting suitability requirements versus is this in your best interest? That's huge. And we are bound. We are bound by that, and you should always seek out somebody who is.
And not everybody in the investment field is bound by that, so that's an important question to ask. Don't assume that they are bound. Make sure that they are.
Well, we know what assume is, right?
Typically
we won't say that on the air. Ask you me. So our free giveaway today, if you've got a question, one of the questions we typically get, and I guess we really only have time for one, it is a very common question, is, again, and what was one of the best guidelines I can use? Everybody I've got two people, they're both doing these things. What's my best guideline? How do you feel? Go with your gut. I like this person. I connect with them. When I ask a question, they're prompt. Their service team supports. I mean, all that goes into that. But how do I feel about that organization? How do I feel about when I'm sitting there? And you have an intuition, ladies, that us guys have to work harder at. But over 32 years of doing this and everything else, I've developed a little bit of that. And I know when I'm sitting there, I'm just saying, I just don't feel good. I just don't feel right with this person. So I think that's a deciding factor, ultimately, if you have two that look the same.
It's a relationship. You both got to be happy, not just one of you. And if one of you isn't happy, it's typically not going to work out in the long run.
Exactly. Call the first 10 callers or contacts to us will get the free financial organizer, priceless, $150 value, free to you. Packed full of information and just little slots in there. You can put statements and information and estate planning stuff, everything kind of A to Z. So another good show.
It is.
So they can go onto our website and pick up some good things.
Yeah, straighttalkcleardecisions.com. Go and ask for any of the free white papers on there, whether it's on investing, whether it's taxes, whether it's insurance or estate planning. And, follow us on Facebook, Rick Saylor Financial. You get some live up-to-date feeds and news each and every day.
Well, you've been listening to the Straight Talk Clear Decisions show, and we really appreciate you joining us. I'm your host, Rick Saylor.
And Eric Hamburg.